Technical accounting questions. Once the interviewer has an idea of your background, they'll want to learn about your relevant skills and experience by asking you technical and knowledge-based accounting interview questions. Let's start. 1. What are the different types of accounting? There are two main types of accounting, financial and managerial. Financial accounting primarily deals with reviewing and reporting transaction information, while managerial accounting is much broader, looking at a company's financial health and future. However, you can also discuss some other specialties within accounting. For example, cost accountants focus on production and sales costs, typically for industrial companies. Tax accountants, on the other hand, handle registering, preparing, and filing tax returns and tax payments. 2. Define and explain the three financial statements. The three types of financial statements are balance sheets, income statements, and cash flow statements. These statements are a big part of every accountant's job, reading and interpreting or creating them. Your answer should include the purpose of each statement and what each statement shows. For example, balance sheets show liabilities, assets, and shareholder equity. A balance sheet shows a company's financial position at a given moment. Assets should be equal to liabilities and shareholder equity, or, in other words, balanced. Income statements are typically quarterly or annual reports that break down a company's operations. This statement shows a company's revenue, expenses, and taxes, resulting in the net income or profit. Cash flow statements show a more detailed overview of a company's incoming and outgoing cash than the income statement. This statement is useful for determining if a company can continue paying its bills and invest in growth down the line. 3. What is the difference between accounts payable and accounts receivable? Accounts receivable are assets. The company will collect this money in exchange for already sold goods or services. Accounts payable are liabilities. The company owes this money to someone else for goods or services. 4. When would you capitalize a purchase, rather than expense it? Generally speaking, expensing is used if the company will consume the purchase immediately. It's not an investment. Purchases that will be consumed over a longer period of time should be capitalized. For example, if the company will use the purchase for more than a year or two, such as a company car or a new piece of machinery, it should be capitalized. Immediate expenses, like employee salaries or paper for the office printer, should be expensed. 5. What are some ways to reduce human error in the accounting department? There is no right or wrong way to answer this question. You can focus on specific skills that can help the team prevent inaccuracies, such as attention to detail, time management, and organization. You can also focus on the software you found useful for catching or preventing errors or ways you've automated certain tasks to keep everything accurate. Additionally, you can discuss the key areas to pay attention to, such as invoices, receipts, and tax documents. 6. What is the accounting equation? The accounting equation is a core principle of accounting. It states that a company's liabilities and equity are equal to its assets. The accounting equation also relates to the balance sheet, which shows a company's assets, liabilities, and equity. 7. Define EBITDA and how it relates to accounting. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. EBITDA is a measure of a company's financial health because it gives insight into how well a company can generate money. While every accountant should be familiar with EBITDA, it is crucial for certified management accountants, CMAs, since they deal primarily with the health and future performance of a company. 8. What is working capital? Working capital is a company's current assets minus current liabilities. Working capital is a company's money to use for day-to-day operations. 9. How would you determine if a company can afford its short-term commitments? The best way to determine a company's ability to cover short-term commitments is by using the current ratio. The current ratio involves dividing the company's current assets by current liabilities. This ratio is sometimes referred to as the working capital ratio because it determines how much of the company's liabilities will be covered by current assets. 10. What is PP&E, and how do you record it? PP&E stands for property, plant, and equipment, or a company's physical, long-term assets, such as buildings, furniture, and vehicles. PP&E is recorded on the balance sheet. You should account for any depreciation and consider any capital put into these assets, such as additions or upgrades. 11. What is the difference between deferred revenue and accounts receivable? Deferred revenue is money the company has received but has not earned. For example, imagine a client prepays for their driveway to be repaved. Their payment is counted as deferred revenue until the company fulfills the service and repaves the driveway. Accounts receivable is the opposite. This is money the company is owed for services already provided. If a company repaves a customer's driveway but the customer hasn't paid for it yet, the due payment counts toward accounts receivable until the invoice is fulfilled. 12. How would a large purchase, such as a new piece of machinery, affect the three financial statements? To fully answer this question, you'll need to ask for further information about how the machinery was financed, when the machinery was purchased, and whether the answer should be for the time of purchase or for a later date. If a company purchases a $5,000 piece of machinery on credit, that is a $5,000 liability and a $5,000 asset. The machinery's value should be added to the company's PP&E on balance sheets. The cost of the machinery is an expense on income sheets, and the transaction is recorded on cash flow statements. Additionally, the machinery's depreciation will affect all of the company's financial statements. 13. Describe the difference between accrual accounting and cash accounting. The accrual basis of accounting means money is counted even if the cash hasn't been received yet. For example, if a company allows for deferred payments, the promised or owed money will still be counted even if it won't be collected until a later date. Cash basis accounting only counts money once it has been received. So, if a company uses deferred payment plans, the money for those services will not be counted as revenue until it has been received by the company. 14. What types of accounting software programs are you familiar with? If you know that the company uses specific accounting software that you've never used, focus instead on the software you know and your confidence in those skills being transferable. Never lie about your level of familiarity, though.
Thank you for watching, and wait for us in the third part. Please follow the channel to follow everything that is new.